Good evening to those of you in Europe. Good morning for those of you in Latin America. This is the last Wealth Talk this year. Today we will be having a series of experts who will tell us about the market conclusions for 2022. Well, we will establish a series of strategies that I hope will be useful to you and you can apply them to your own investments. I'm going to be very brief, but starting by 2021, we always like to see what we said last year and whether we got it right or not. Last year, we issued a report called Recovery and Disruption, and I think we really hit the nail on the head. This was not the case in 2020 because after we had issued the report, we had the COVID outbreak. We wouldn't have dreamt that that might happen. But in 2021, we did get it quite right. And what we said has really come true. The market reacted very well to the different fiscal measures. Then the global economy had a very sharp growth in line with the recovery prospects. And the effectiveness of the vaccines has been such that we managed to go back to an almost normal, although there's a series of concerns now related to the Omicron variant, which has raised all alerts, and we'll see what happens. But we are quite happy with how the year has gone so far. Now, the new report bears the title Investing in a World in Transition, because we are entering a highly changing environment which is going to bring with it many opportunities, but will also require a very active management of investments. The general tone in the report is positive. What we see is that the monetary conditions are still favorable to investments. We still have a firm economic growth, and in spite of all that, we shouldn't forget that we have a series of risks, and monetary and fiscal policies will have to change at some point, and there's a series of sensitivities that are going to bring about a series of changes. I'm talking about the environmental regulations, inflation, etc. If we forget about the virus, inflation is for us the main risk going forward, and excess growth and problems in supply chains have been such that this ghost of inflation has reared up its head, and so this may mean that we should protect our investment portfolios. Against this background, we can still see many opportunities and many things that need to be done. First of all, we believe that the geographical approach should be diversified and global. We need to have a global exposure. We believe that in this attempt to protect our portfolios and diversifying, there's a series of markets, namely private markets and alternative investments, which are still going to be very important going forward. We believe that there is another thing, which is this energy transition. And in this world under transition, we've had significant growth. Now, we believe that things will have to slow down, but this is a trend that we see is going to persist going forward. And then as far as innovation is concerned, we have our own themed funds, and all of these things are still going to be very important going forward. We need to keep up our diversification. We need to look at private and alternative markets. It is important to work on sustainability and transition towards clean energies. We need to keep up innovation. And this is what our teams are going to be discussing, and I hope you enjoy the session. And that's all I wanted to say. I just want to thank you for your trust. I hope this is useful. You will receive the report anyway, and rest assured that we will support you in anything we may. So I'll give the floor to Juanje Sanchez-Rosell and the other experts who are going to give you a lot more details about what I've just said. Thank you very much. I will stay connected, and I'm just going to sit in on the session because I'm dying to learn from the experts. Thank you. Hello. Thank you very much for this kind introduction, Victor. In this presentation, we have the strategy managers for Santander Private Banking Spain. And we also have Ana Rivera, who's responsible for strategy in Santander Asset Management. Together, we're going to try and explain this market vision for 2022, where, as Victor said, the title of the report this year is Investment in a World in Transition. So, let's begin by talking. Sorry, I am going to change the view. I will just review the transition from 2021 to 2022 in terms of the growth in economic activity, also in terms of the health variables and in terms of the markets. And then I will talk about the changing dynamics for 2022. Alfonso, let's make a brief analysis of this economic recovery. As Victor was saying, this has been thanks to the fiscal and monetary packages. And what we can see in these four graphs is a V-shaped recovery, one of the fastest recoveries in history. What has been the underlying dynamics here? Hello, Juanje. A good day to all of you. As Juanje has said, there was a massive response to the crisis by the authorities, and recovery has also been massive. You can see from the graphs that it's been a V-shaped recovery, and now the global economy is very close to recovering its pre-pandemic levels. And next year, the recovery will be complete. Economies like China have already reached that full recovery, and Europe is about to reach it. This is something we wouldn't have anticipated last year. But we might wonder whether next year there are any risks of, for this recovery, any risks that this recovery might derail. But you've got to take into account the consumption levels. Families have amassed significant savings in the last 2 years. In the United States, for example, savings increased by 7%, and leverage, has also gone down significantly. And then we should also talk about investments. Now, investments are going to be helped. First of all, there's going to be a lot of public investments. So stimulus plans have been announced both in the UK and in the EU, and also private investment is going quite strong. The levels of capex have increased significantly. So we do believe that the world economy will still grow next year above its potential, and this recovery is going to be sustainable. We should also talk about trade. This is a variable that has had its ups and downs since 2008, but in no time did it recover the traction it had before the financial crisis. But this is starting to change. It's going, there are some data which ease the fears that that bottlenecks might develop in supply chains in Korea and Japan, which are very important for supply chains, have had high levels of inventory in the last few weeks, and so bottlenecks will little by little be relieved. But there may be some volatility in the economic cycles. So, Alfonso, the economic side of things, so we will close this year with growth. There is fuel to promote this growth, and so the only shadows would have to do with this rise in inflation. But let's turn to the other side of things, which has to do with the healthcare situation. Anna, tell us, because here we see that the recovery has gone in the same direction. There's been an improvement both on the side of the vaccines and on the recovery of mobility. The only concern is the number of infected people. We can't seem to get this to stabilize. What is your take on the healthcare variables? And tell us something about the Omicron variant. Well, you are right. The appearance, the emergence of the vaccines has made the economic recovery possible. The recovery started when the vaccines were announced. And if you look at the graph that shows the number of infected people, you see all the different variants that people are so concerned about. The most concerning one was that first South African variant, then there was a Brazilian, and then at that time vaccines were not really widespread. Now we need to make sure that more and more people get vaccinated. There are some countries that are still lagging behind. For example, in Germany, the vaccination rate is lower than 70%, whereas in Spain, vaccination has exceeded 90%. So vaccination will make the difference. And this is also reflected in mobility. So when vaccines started being deployed, mobility was authorized and restrictions were lifted. And that is why we're all waiting to see what happens with the Omicron variant with bated breath. It is quite infectious, apparently, but its effects on people's health do not seem to be too worrying. So we need to take into account that I'm going to give you an important figure. In the world, in the last 28 days, in the last 28 days, 15 million people became infected. Of that 15 million people, the same 28 days, 1.1 billion doses of the vaccine were applied. So the rhythm is good, so we need to make sure that the vaccination rate increases. Yes, of course, we need to trust vaccines. Vaccines are the solution. And there is certain uncertainty around the effectiveness of vaccines against this new variant, but let's hope for the best, and let's hope that there is good news and that we don't go back in this respect. Nicholas, the last conclusion about the evolution of 2021 has to do with markets. The recovery in markets has been even greater than in activity and economic growth, right? What did you tell us about the different markets, please? Yes, you are right. As economic growth has emerged since the end of 2020, So the main magnitudes have improved, especially the stock markets, commodity markets, and corporate bonds. If we analyze one by one, you will see that the stock market was really benefited because as a result of the spread of vaccination, consumers and investments by central banks and by governments have resulted in investments being made in the assets with a greater exposure. Then oil and other industrial commodities had a very good performance in the second part of the year. There was a certain acceleration, which we believe is going to become more moderated. In terms of trade, central banks decided to make acquisitions in certain markets, and so companies reduced their delinquency ratios. Delinquencies went down significantly, and so many investors felt comfortable investing in corporate bonds. The only segment that had a performance different from others were there has been significant recovery at the level of pre-pandemic values. Is that of interest rates. Interest rates haven't had the same performance as other assets, and this, for me, is the biggest query that we have going forward in 2021. But generally speaking, good performance of portfolios and good, and this has resulted from the different stimulus packages launched by governments. I would like to add something too. The good performance has specifically been experienced by investors because, people who had savings accounts really did not benefit too much because interest rates were at a record low level. And then, of course, there's a difference between industrialized and emerging countries where stock markets behaved in a more negative way, particularly China and Brazil. So a year for global recovery with certain nuances. And now we will turn to the second section where we will be looking at the change in the dynamics for 2022. In 2020, we emphasized, in 2021, we emphasized recovery, and in 2022, there are good growth indicators, but we see some areas of concern to do with transitions. And let's look at the first one, which is the transition in the monetary framework. Alfonso, let's talk about what Victor was saying. Our main concern is the progressive increase in the inflationary expectations. Here you can see how these are the market expectations. Here you see how the recent data, in the recent past, in the United States, inflation rate was of up to 6%. But, how do you think central banks are going to react in this complicated environment for them? Because they want to keep interest rates low to promote growth, but they also need to preserve price stability, and inflation is not helping in this endeavor. So what can you say about 2022? Well, you had really hit the nail on the head. It's very important. It's very important for price expectations to stay stable. And so far, so good, because since Paul Volcker got to the Federal Reserve, things have been very stable. We don't know whether this is going to last very long, but we do believe that next year inflation will slow down and the levels will be much lower than those this year. I think that should be said at the outset. We believe that central banks are going to be extremely cautious because they know that a very aggressive rise in interest rates might derail growth. And so we believe that starting by the United States, the Fed will start increasing interest rates at the end of next year they will probably increase interest rates by 1 percentage point in the course of 2023. So the market considers that the next interest rate hike cycle will be more moderate than the cycles we've seen in the past. In terms of developed markets, in Europe, we believe that there will be no interest rate hikes on the horizon. Other countries such as New Zealand, the UK, Norway are suffering some tensions, and they want to combine tapering with asset investments. Well, I don't think that they will do anything radical. In terms of emerging countries, there has been an exercise of anticipation. There have been some idiosyncratic factors, but the photographs you see on the right, and if you compare it with the left, is very different. There have been interest rate rises in Latin America, in the emerging countries. They have always been less tolerant to hikes in prices. And the Bank of Brazil is extremely orthodox, and they're increasing rates according to their mandates, whereas other central banks, such as Turkey, in Turkey, the central bank is less dependent, and this has resulted in lack of control and harm to investors. So we believe that the work has been done already, and this is positive because the emerging countries here have taken the lead, and probably the measures taken by the Federal Reserve will not be as aggressive as those measures taken in previous years. Now, in terms of growth, you were conveying a positive message. Slowdown, and you were mentioning several factors that would contribute to growth in 2022. And then as far as inflation is concerned, the message you were conveying is different in emerging countries from developed countries, because in developed countries, I think that the message was positive because central banks are, if, of course, these expectations are met, central banks will be able to soften the interest rate hikes, managing to convey to the market the message that they are in full control of inflation dynamics. However, in emerging countries, the situation is more advanced in terms of the tightening of interest rates, and but perhaps these emerging countries at the end of the year might already have done their homework in terms of managing the interest rise cycle. Would you agree with this summary? Yeah, you couldn't have done it better. That is our view in terms of growth and in terms of inflation. Then we will try and talk about the implications of all this at the market level. Anna, let's turn to another sphere, which is the transition that we're witnessing in the sensitivity both of society at large and in the priorities of governmental policies regarding care of the environment. Certain very important fiscal programs have just been approved to do with the investments in recovery, and we have tried to compare them. We have tried to compare the contents of these programs, the part that it has been approved and the part that has not yet been approved, comparing Europe with the US in terms of investments in the green transition, in technological infrastructures, and in social programs. These are important figures, and the idea is to move towards a zero emissions world. What can you tell us about the impact of these programs? Yeah, the idea is to facilitate this transition. This transition is a decision that has already been made. It is a reality. There's the energy transition, which is also a social transition, because it is essential so that nobody is left behind. However, the next few years, this money here, which is a lot of money, especially if we look back and you look at other recovery programs for previous crises, which were not so centered on specific topics. This one is different because it was decided that on this occasion, these programs, which are financed with public money, should be targeted at achieving that transition, that green transition. And the US and the European policies are the cornerstones which have determined and have dictated the priorities of other geographies. And so money needs to be invested in technologies, and this is very clearly specified, how much money is invested in what. And a significant part of the green transition also includes that type of investment. So it's a change in the way in which energy is produced, both clean energy and CO2 capture, or CO2 capturing energy. This is going to mobilize a series of resources across all sectors and across all industries in order to mobilize capitals. These are plans that will be updated year on year by all the different countries, and they will gain even more momentum as we move towards 2030, which will be the first exam that we will have to take. The finish line is 2050, but 2030 is going to be very important because 90% of the countries in the world have committed to this zero emissions economy, and they will have to present the first results by 2030. So all of this process will be more and more tangible as these technologies develop, and this will require a significant effort. Anna, this is a very important topic. These programs, these fiscal investment programs are very important. I think that there's a big difference between this crisis and the previous crisis, and that difference has to do with these stimulus packages and how a decision was made to delay fiscal austerity until economic recovery is achieved. And the United States is the country where fiscal packages had greater size. Fiscal deficit was around 15% in 2020 and 2021 in the United States. And people were afraid of a slowing down in fiscal packages, and people were afraid of losing these subsidies, but Biden's administration implemented a fresh series of programs which will help make the transition less traumatic. So tell us about this slowing down perspective in fiscal packages. Well, as you were saying, one day, Biden's administration decided to listen to the investors community and decided to promote a change in the infrastructures of the United States. And so all the transfer of money from the government to SMEs and individuals through the American Rescue Plan of 1.9 trillion is meant for the crisis to be as V-shaped as possible. But secondly, the Americans are realizing that the US economy hadn't invested in infrastructures or in technology for a long time. And so they believe that the future, especially at the level of productivity, will be based upon increasing these investments. Last week, an infrastructure plan was approved, and now they're going to approve a second plan, and these plans are meant to improve the productivity of the United States. The flip side of the coin, of course, is that these plans have been associated with an increase in the borrowing levels of the government, and so in the future, the Fed will have to probably increase taxes. This will happen anyway in the second part of the decade, from 2025 onwards, so we shouldn't be concerned about this in the short term. But as you said, this transition is going to be progressive, and if interest rates do not rise above the growth rate of the American economy, investors will feel comfortable with these policies, even if there is a certain slowdown with respect to the previous 2 years. So, on the horizon, we're going to be witnessing a lower support, but this transition will be staggered. In 2022, we can't see a situation where markets might face any concerns. But 2023 and 2024 may be a different story, because these deficit levels, well, bondholders might go back to demanding stricter fiscal discipline, and at some point there may be some volatility events, and the word austerity might go back to the economic headlines. But the situation we have analyzed with our experts, with our global experts, is that 2022 will compare negatively with 2021 in terms of growth, in terms of support packages. All of that happened basically in 2021. In 2022, there's going to be less support, less economic growth, but not that much lower, 5% lower approximated at what level. There's going to be a slowing down of profit levels. So it's going to be a more difficult year. It's going to be a year where there's going to be a complex transition, but for the time being, it's still going to be positive on the whole, because this, it's all going to be a moderate process. That is our interpretation of the transition that we believe will start happening in 2022, and which will probably result in a certain volatility and a different performance. Let's turn to the third section of the presentation, which is the opportunities that we see in this transition to 2022. And I will start with the first recommendation, which is to maintain the level of investment. This is one of the key variables in order to success in the business world. When there is volatility that doesn't yet change a positive scenario, we have the three key ingredients for risk assets. Well, they still have a positive bias in terms of profit and economic growth. And the monetary conditions are still positive. The interest rate hike process in developed markets is going to be quite moderate in our view. So this environment, characterized by low interest rates, is quite positive both for credit and for the stock market. And the stock market, we believe, may still have a positive performance in 2022 because of this increasing profits and because of the relative valuations, because since interest rates will still be low in developed markets, then stock markets will compare favorably with fixed income securities, and this might drive the profitability of the world's stock markets up. If you compare the returns from the stock market to the returns of fixed income, you see that the former are higher. Our recommendation is to keep the risk level, not to increase it. The most positive part of the economic cycle is already behind us. That was the growth peak, both in profit levels and in economic terms. That is already behind us. That is something we had at the end of 2020 and the beginning of 2021. But we're still in a phase where there are many arguments that justify investments in variable income. The second argument, and of course this depends on each person's risk profile. The second argument that we would like to share with customers is volatility. We have said that 2021 was a year where everything, especially, apart from this final variant, 2021 was quite calm, and news was in general very positive. An improvement in the health situation, improvement in the economic growth, and improvement in the growth of profits. 2022 presents itself as a more complex year because of the transitions in the economic realm, in the fiscal realm, and in the inflation arena. So going forward, it's going to be very important to use active management because volatility means that there's going to be lots of ups and downs, and so it's going to be very important to have vehicles managed by professionals that can add value to the active portfolio and with the expertise necessary to make changes across different assets. So the idea is to preserve and maintain the level of investments, provided that there are no bad news, provided that there is no bad news on the healthcare front, and provided that interest rates remain under control by central banks. And the second ingredient, Alfonso, I will give you the floor. How would you manage this more complicated part, which is investing in fixed income? Could you explain this graph to us on fixed income? Well, this is a real hot potato. Fixed income in the past was the easiest to manage asset. But in the last few years, it's been difficult to manage fixed income securities. And now with inflation, well, things are becoming even more complicated for fixed assets. And there's a big difference between the nominal rates, between the nominal rates and the underlying inflation. So, and this is an issue which raises the bar for conservative savings, and so fixed income investment strategies need to be much more flexible going forward. As regards governments, I think that for next year, this monetary policies will probably change, but in the first part of the year, we will have to be very careful. In the case of Europe, there may be windows of opportunities with a more tactical component, especially in the periphery. If Europe keeps applying the current fiscal policy, we believe that governments, we will have to be careful in terms of the duration of government mandates. Now, in terms of, so the starting point now is that we consider, to the extent that the carry is more attractive and the high yield securities are attractive, so we believe that we should take advantage of this opportunity, but as the cycle goes on, well, we will reach a transition. We will probably have to go for securities with higher ratings, and the message for credit is that high yield should be preponderant, but investment-grade securities can also be used. And then as far as emerging countries are concerned, emerging countries this time have been very proactive, and next year we believe that lots of value will surface because there is a lot of carry in fixed income, but we need to keep applying a very highly selective criterion and choose issuers that are institutionally credible and who are very orthodox, and of course the fundamentals need to back any decisions made. For fixed income, a lot of flexible management, a difficult environment. We will need growth opportunities. With the news you gave us before, Anna, about this transition towards this huge investments in this transition towards a zero emissions world. I'm sure there's going to be many, many opportunities. Of course, climate is a very important axis by itself, but it will affect all other asset categories. There's no doubt about that. This is something we will have to take increasingly into account. So climate will cease to be a niche investment and will become a mainstream investment because it will be pervasive. It will affect all other investments, especially for private capital, because of course public capital is essential to set standards and to keep things going, but a series of private partnerships have been established which also are trying to mobilize sustainability, and this, together with asset management, generates a capacity to select securities which will be essential going forward. Sustainability opens up a lot of opportunities. And what about equity? Variable income. It will still be critical to make portfolios profitable, right? Now we are at maximum levels of business margins. The costs of raw materials are going up. So what is the prospect for 2022? Are these margins sustainable, and where do you see the best opportunities? Well, we believe that in the 2022, because of the growth we will have in the stock markets, the year will be very positive in terms of profit growth. In 2021, we had an excess because of the government policies. This year will be a little bit more normal. But because of the disruption of coronavirus, many companies have increased their investments in digitization, and so the margins increased spectacularly. We believe that, generally speaking, these margins will be preserved, and we believe that the sectors and industries that have stood behind digitization will be the main winners, specifically the financial sector and the healthcare sector are, in our opinion, one of the most attractive ones for 2022, but we shouldn't forget other sectors or new industries which we believe may keep moving forward in 2021, such as cybersecurity, the Internet of Things, energy transition, and artificial intelligence. As you were saying at the beginning of this third section, next year we need to keep invested. There may be some overweighting, because even if it is going to be a volatile year, we believe that fixed income will generate considerable profits. Yeah, or at least, it should be at least as good as in 2021. And that brings us to the need of looking for opportunities beyond listed markets. People keep talking about private equity, private debt. Investing in these markets requires a greater complexity, and sometimes you need to forego liquidity. But some investors have the capacity to invest in these markets. In Miami and in Geneva, in private international banking, you have recommended these types of investments in the last few years. So what has been your experience in investing in these assets? Have they really been that promising? Yes, they have. In fact, all investors in a traditional portfolio, fixed income or variable income, because of the reduction in interest rates in the last few years, well, they saw how their profits shrank, and so they asked us for an alternative investment. So we created a new department for alternative investments, and we started exploring the possibility of incorporating these types of investments to our portfolios for several reasons. First of all, to increase the profitability that our customers get, and also to diversify the sources of return. These types of assets are very important because they're assets that are illiquid, which means that you need to keep them for some time, because the exit windows are 5 to 7 years, and also they're also asymmetrical. Here, many of the businesses are businesses where information is difficult to achieve, and the expertise of a good manager may be such that the return may be very good or very bad. So we've come to partnerships with the main private equity companies in order to make it possible to our customers to have return surpluses. And these surpluses have stayed very high in the last 24 months, as you can see from the slide. And they have diverted the liquidity to these types of assets. And in the medium term, the returns, in the medium term, investment in these assets will increase. The proportion we invest in these assets will increase. So, in the developed world, fixed income is has very low returns. So this forces us to look for non-conventional assets and diversify portfolios to achieve profit levels that are in excess of inflation. And for that, it is more and more necessary to provide more comprehensive advice. This is the summary of the 6 recommendations we believe are key. The market outlook document that we have drafted at a global level has more details about this, and in the next few weeks we will give you access to this document and discuss it with your bankers and advisors. We decided to limit the presentation to these contents in order to have time for a short Q&A session. I have received some questions already, which I'm going to be putting to my colleagues. Here there is an interesting question about energy transition and with respect to commodities. They're saying that investing in renewables is very interesting, but if you look at the revaluation of assets, the most profitable has been to invest in coal, which has gained 80% value, or natural gas, which has increased by 300%. So we were talking about transitions and about how complex these dynamics are when we go from one environment to another. And here, in this question, we need to consider 2 things. One of them is the long-term view and the short-term view. The long-term view is what Anna was saying. There is a commitment by countries to abandon fossil fuels, coal or natural gas. And in the long term, I don't know, Anna, I think that they want to grow, increase. Investment in these energies is going to be very limited, and in the financial sector will not invest in them either. Yeah, well, now the price of fossil fuels is increasing because of geopolitical reasons, short-term reasons, but in the longer term, the increase in fossil fuels, in the price of fossil fuels, has to do with the fact that they still cannot be replaced. But that price, which is higher and higher, is precisely what is going to force the transition to take place faster. Because, the days of those fossil fuels is counted. So it's a two-edged sword, both for producers and for users. What in the short term might look inconsistent is very easy to understand in the longer term. The higher the price of these energies, the greater the obligation will be to embrace renewable energies, which will become cheaper and more widespread. Yeah, but we need to balance the short term with the long term. What is happening in the short term, Nicholas, is that no investments are being made in capex for fossil fuel energies, and therefore prices may keep high in the short term because the supply is going to be decreasing. Yes. To answer the question from this customer, the price has risen because the supply has not adapted to the strong demand in the last 18 months. And this is what we need to look at in the future. Today, Russia was saying that perhaps they might increase production, and the price of oil fell by 4% overnight. So that offering with coal or oil increases, then prices should go down. And as they go down, that transition might become more effective. And we believe that prices will be maintained, but they may go down in the medium term. Thank you very much, Nicholas. We have several questions on emerging markets. Asian stock markets have been disappointing in 2021. There are several factors that have influenced the poor performance of these stock markets. Alfonso, what is your view in terms of opportunity for 2022? What should happen for these stock markets to have a better performance and be able to benefit from a recovery? Well, there's two things here, Juan de. First of all, the gradual recovery of supply chains or value chains that are agents in Asia or in Korea who would benefit from this. And secondly, I think that China will become the focus of many investors. There will be a big opportunity in China because there's been increasing regulation in different sectors, including real estate and demographics. It's a way in which China wants to make its hegemony prevail, and it's an economy based practically fully on consumption. And we know that in 2014, when they started with devaluations and credit growth, since then, China has followed a carrot and stick policy. The monetary policy of China will not be upsetting. And when we speak about China, we should also say that 83% of employment in China is created in the private sector, and that the Chinese government has regulated a series of sectors, but they also promote consumption and green technologies. And so the evaluation curve that we have seen in China entails a good opportunity. 2022 is going to be a volatile year, but I think that there's going to be opportunities in economies which have solid fundamentals, and China will be no exception to this. Yes, we will be attentive to what happens in China, which is a key country in the emerging world. And there's another question about the stock market, which has to do with the dichotomy between the European and the American stock markets. The American stock market has been, in the last few years, it has been the stock market that has led profit levels. Yesterday, I was looking at the statistics to do with returns in the last 15 years, and the American stock market had an annual profitability of 10% as compared with 4% of European stock markets. And one of the graphs that we have included in the annual report explains that practically this difference has been due to a better performance of profits of American companies. Over 80% of profitability of differential has been due to a higher profitability of American companies, especially technological companies. Nicholas, what is your take on the performance for 2022? The profit expectations this year at last, it seems that Europe can have more or less the same profit growth as the United States, and they have the support of a significant fiscal package. Could this be a good year for European stock markets? Well, from the point of view of an investor who invests in US dollars, well, first of all, the American fixed income is still going to perform well. And so this should be one of the main preferred investments. Of course, Europe, as it is facing a slower recovery than the United States, and given that interest rates the first hike will happen 12 or 18 months later, we believe that there should be a good economic recovery, and so the growth in profits should be quite promising. So both regions are bound to have good performance throughout the year. We still have many questions that we will not be able to answer. We will try and answer them by email if you leave us your details. I would like to thank the heads of Santander Asset Management and the head of Santander Private Banking. I want to thank them for joining us today, and we will be very attentive to the transition factors that we have conveyed to you to strive and give you the best advice in the coming months, which I'm sure are going to be very interesting. Thank you very much for joining us, and thank you for trusting Santander, and thank you for entrusting your investments to us. Thank you.